Today we are going to see return on equity. In the previous videos we have already completed return on assets, return on invested capital, return on capital employed. Now we will see return on equity. Return on equity is nothing but net income to the common shareholders equity. This return on equity expressed in terms of percentage. This net income generally calculated after deduction of dividends, taxes and payouts. And common shareholders equity is nothing but net assets minus short-term liabilities or liabilities, generally debts. And if a company is reporting high ROE, means the company has more ability to convert its shareholders equity financing into the profits. Generally ROE will change depends on the industry and sector. This net income we generally obtain from the income statement, whereas this shareholders equity we obtain from the balance sheet. And what values of ROE is considered as good values? Let's say utility sector, which is generally reporting ROE 10% or less, whereas the technology firm reporting which is 18% or more. Here the difference is the utility sector has involved more assets. As a result, the denominator is higher value, so which represents lower ROE, whereas the technology firms don't have much assets, as a result which represent higher ROE. The thumb rule what we need to consider is ROE of the any company which is more or less close to the sector ROE or which is slightly greater than sector ROE is considered as the good ROE values. If the ROE of the company is 2 times or 3 times sector's ROE, means which not to be considered for investment. Extremely high ROE value sometimes represent small equity compared to the net income, which indicate the high risk. Next we will see how we can utilize this ROE. Let's say company A has ROE 15%, let's say company B has 15%, and both are operating in the same segment. In this case, how we can choose for which stock for the better investment? So in this case we need to consider the SGR, sustainable growth rate, and other aspects. Let's say the retention ratio of the company A is 70% and the retention ratio of company B is 90%. The retention ratio is nothing but the portion of earnings or the portion of some net income retained by company for the future growth and not to pay out to the shareholders. It is simply nothing but retained income with the company. Then we will calculate a sustainable growth rate of the company A is 10.5% and for the company B is 13.5%. Sustainable growth rate is nothing but the company can sustain without borrowing from the outside. Then in these two cases we will consider company B as a better investment, though both the companies are reporting same ROE values. Next, the ROE can help us to identify the problems. First one is the inconsistency profit. Let's say if the company is continuously making losses, means it can reduce the shareholders equity, so which reflects in the high ROE when company returns into the profits. Here because the denominator is becoming very small and small. Excess debt. If the company has more debts than the lower equity and which reflects in the high ROE. If the company has negative net income, ROE should not be calculated. When company has negative shareholders equity or losses. In that cases we can't calculate the ROE of the companies. Thank you.